couple announcements. On June 5th, we have a Braves outing. And the deadline to register for that is noon on Tuesday. So that should be a fun event. I think we're doing that with the Alabama chapter, I believe, again. June 27th, we're going to have our next chapter meeting, which is going to be Metro Atlanta Development Projects. So we look forward to that one. That's one that I'm really excited about as well. August 8th, we will have a Site to Do Business training section. And that, encourage all you all to attend that. I've done that a couple of times. I would like to thank all of our chapter sponsors, Marcus and Millchap, the platinum sponsor, Ackerman and Company, which is gold sponsor, Standard Landscape, the Simpson Company, First Colony Financial Corp., Adams Commercial Real Estate, Strategic 1031 Exchange Advisors, Wells Fargo, Excelligent, Bank of North Georgia, Anderson Tate Carr, and last but not least, Brand Properties. So we'd like to thank all of our sponsors for 2013. In preparing for this program, Where's the Money? The State of Lending in 2013, I took the time to go back and look at our past programs, and specifically which had addressed the capital markets and lending. And it's funny, we really hadn't really delved into this subject since June of 2010, 3 years ago. Now, we've had panels on distressed assets, panels on different areas of the backside of lending, but we haven't really talked about lending in a few years. Well, when I watched that program, it was sort of amazing, the gloom and doom story 3 years ago. And I'm surprised I'm still in the business after listening to that video on the state of lending in 2010. So hopefully we've come a long way, and look forward to our panelists informing us on the state of lending in 2013. I'm honored to introduce our moderator, Erwin. He's the managing director of underwriting and structuring for Regions Bank. He's been with the bank for 10 years, and in 2003, when he joined, he was responsible for launching the debt placement platform at the bank. In 2006, when the bank entered into 2 mortgage loan purchase arrangements, he assumed responsibility for underwriting and structuring for the group. In his role, he has evolved in origination and closing of CMBS loans for the group and advises the bank with commercial real estate term loans. Alex also serves on credit committee for HUD loans originated by capital markets. Prior to Regions, Alex worked at Land Lease Asset Management in the Debt Advisory Group, where he evaluated CMBS bonds on behalf of land lease clients and their house accounts. And prior to that, he was a banker at Wachovia, then also did real estate management in the Deloitte Touche Consulting Group. A real Tar Heel, Alex hails from North Carolina and graduated in business administration and also received his MBA from North Carolina. I'd like the group to welcome Erwin.
Thank you, Mike. Yeah, thank you. Good morning, everybody. I really would rather not hold the mic, but I guess I need to do so to get myself heard. This morning I'm reminded of something that seems to happen routinely in my household. Whenever I'm about to do something important, my wife kind of gives me a little nudge to make sure that I've got a fairly good understanding of how important it is the thing that I'm about to do is. Well, this morning I walk out of the car and I'm heading into the building here, and I forget my business cards. And so I step back, go to the car, get the cards, and I'm looking down at my BlackBerry, and I got a little nudge. I walked right into the concrete pier with a little hole in the middle of it, thinking that I could slide right underneath it, but being 6'2" and that being 5'8", I didn't quite make it. So I got my nudge this morning on this, guys, so I'm hoping I can keep it in the road here for you. The question we've got in front of us today is, where is the money? It's a great question. We are in an economic recovery after all. It's been that way, I guess, since early 2010, but since the credit crisis hit us in late 2007, and because of it, the financial system has been forced to rethink a lot of things, and most especially the management and pricing of risk. And it's been doing this all the while. It's been processing sometimes conflicting signals and in a fairly complicated business environment to boot. We all remember, I guess, the failures of some very big and very well-known financial institutions that seem to echo in our past here, and we'll kind of run through a couple of those. You all remember Wachovia, an institution that we all probably know and loved around Atlanta here. It had been around since 1879, and it was sold in December '08 to avoid a failure. Lehman Brothers, over 100 years old, bankrupt. Merrill Lynch, in business for nearly 100 years and clearly a household name among us all, sold to Bank of America. Bear Stearns, it was an institution that had survived the Great Depression, and it didn't lay off a single employee through that period. And they were sold for $10 a share to J.P. Morgan, when only within the last 52 weeks prior to that they had been trading around 133. And in addition to all the catastrophes through those institutions that we saw, many of the remaining institutions had TARP funding to shore up their hemorrhaging balance sheets, which I know a little bit about this morning. Dodd-Frank, adding a new set of complexities to everybody's daily tasks. And not just banks that were out there having problems and dealing with them in different ways. Countries were teetering on the verge of default. Portugal, Ireland, Greece, Italy, Spain, the entire European Union at times being thought of as going into dissolution. Then we had quantitative easing introduced by the Fed to inject capital into the financial system and shore up financial and business investor confidence. And that's pushed interest rates into uncharted territories. And with the math behind all this not being any easier, we've had slow growth in GDP. We've been moving slowly up, but only at about a 2% rate. Our unemployment remains elevated. At the height of the boom in 2007, it was 4.5%. At the height of the crisis, it was well over 10. And now today, it's south at 8, and it's improving, but slowly. Housing starts in '06 at the height of the market were over 1.7 million units a month. By mid-2009, 400,000. Today, around 600. So we're seeing some progress. And the flip side of the coin around housing starts, foreclosure starts. Around 175 per month in '05. Over 600 in '09. And back down to 300 now. So, like this sometimes stormy but often beautiful spring weather that we enjoy here in Atlanta, things are looking up in spite of the rain. And with spring, I'd like to say, we all know what every banker's heart turns to, making loans. And we have evidence to back this up. The Fed's conducted a survey of bankers that measures the level of optimism out there, and they measure this by asking bankers whether they see demand for their loans going up or going down. Equal split gives us a net zero. And at the context, at the height of the market in '05, C&I, commercial and industrial bankers, reported that they saw rising loan demand at a net positive 40%. By mid-year 2009, a net 60% reported seeing declining loan demand in their futures. Today, we're back up into the positive territory, a very good sign. We've got 10% saying they think loan demand is rising for C&I loans. It's even better for CRE loans. At the height of the market in 2005, a net 20% of CRE lenders reported rising loan demand. By mid-year 2009, a net 65% reported declining loan demand in the future. Quite a shift. But today, CRE lenders are saying, on the whole, over 40% say rising loan demands in the future. So we've got good times ahead of us, we expect. So in spite of the noise out there, you are asking the right question. Where is the money? So to help me address that today, I've got three esteemed panelists here before us, and let me introduce them to you, and then we'll get started with some questions. I'll ask the panel a series of questions, and then at the end, I'll open the floor up and get you all to participate if we can. I'm going to start with Craig Hall. Craig joined ReadyCap Commercial in April of 2013. Craig currently serves as Vice President of Commercial Real Estate Lending, covering the Atlanta region. Most recently, Craig served as Vice President and Senior Account Manager at Fidelity Bank, where he was a top producer for owner-occupied commercial mortgage loans. And prior to Fidelity, he was a Senior Account Manager with GE Capital Real Estate in the Business Property Group. Craig has 11 years of commercial real estate finance experience, including extensive knowledge of single-tenant loan programs. Before working in finance, Craig began his career brokering commercial real estate in Raleigh, North Carolina. A native of Cincinnati, Ohio, Craig attended Ohio University in the other Athens up in Ohio, where he received a Bachelor of Business Administration degree in finance. He's a member and former director of the Atlanta Commercial Board of Realtors and currently lives in Roswell, Georgia with his wife and his 2 children. Joseph Reeves. Joseph is a Senior Vice President and Commercial Team Manager for Southcrest Bank. Joseph and his team work closely with their commercial customers to help them choose the best loans for their growing businesses, and he helps them implement solutions based on a comprehensive understanding of their goals and their visions for their businesses. Joseph has 20 years of banking experience and most recently served as the Southeast Small Business Administration Regional Sales Manager for Wells Fargo. His commercial banking experience also includes serving as Business Service Officer for Branch Banking and Trust, where he was recognized as a top performer for his increased loan production. Joseph has spent 8 years at SunTrust Bank, where he held various positions including Small Business Officer, and he was also named a top small business banker in Georgia while there. Following a 3-year service in the U.S. Army, Joseph earned his BBA in Business Management from St. Leo College and a master's degree in finance from Central Michigan University. Joseph is a member of several professional organizations, including the Georgia Lenders Quality Circle and this group here, the CCIM, as well as a member of the Chamber of Commerce for both Fayette and Coweta counties. Joseph lives in Peachtree City, is married, has a teenage daughter, God bless him, and is an avid reader and enjoys playing golf and attending business networking functions. Last but not least is our friend Ken Taylor. Ken is a Business Development Officer and Vice President for the Bank of America Merrill Lynch in the Global Commercial Bank. He's been with B of A since 2011. And in his role, Ken's primarily focused on identifying and acquiring new client relationships with companies having revenues between $5 and $50 million. He's providing comprehensive banking services, financial solutions, and advice to that client base. And he currently serves all metro markets in Georgia, North Central Alabama, including Birmingham, Montgomery, Tuscaloosa, Gadsden, and Anniston. Ken began his banking career at the Bank of Boston in 1989, where he received formal credit training in commercial lending, credit, and financial analysis, and the global banking industry. He spent 8 years with Wells Fargo and its predecessor, First Interstate Bank in Dallas, where he served as a credit analyst and relationship manager and covered a large portfolio of corporate clients in Dallas, Fort Worth, Georgia, and Tennessee. In '99, he joined BB&T in Atlanta as a relationship manager in their commercial banking group, and he managed a commercial portfolio of clients in industries ranging from distribution, healthcare, manufacturing, and technology. He served for a short time as a loan review specialist with the FDIC and assisted them in their portfolio analysis of failed banks throughout the country. Ken's involved in the community, including volunteering with a variety of school-based mentoring programs in DeKalb and Fulton County, and with a variety of civic and neighborhood groups, including Habitat for Humanity, Keep America Beautiful, March of Dimes, and Senior Connections. Ken lives in Lithonia, Georgia. Welcome all of our panelists, please. Let me begin by asking a question to each of you. I would like, if you would, to please explain to the audience by giving a summary of your target customers, your banking, and the types of loans you're making today. Why don't I start with you, Craig, and we'll work our way down. Sure.
Thank you. Thanks, Alex. Good morning, everyone. Appreciate the opportunity to be here. A little bit about ReadyCap Commercial. We're relatively new in the real estate finance world, about 6 or 8 months in, which kind of speaks a lot to sort of what's going on in the market, and we'll get to that, I'm sure, a little bit later. But ReadyCap is a finance company, not a bank, and there's obviously a big difference between the two. So we're based out of Irvine, California, and have loan officers in major markets all around the country, from Atlanta, Boston, Chicago, California, Seattle, Texas. Where we try to fit into the market, and what we have seen as a unique opportunity, is a space in between where traditional financing lives, so banks, life insurance companies, agencies for multifamily, and of course on the other end of the spectrum, private money, hard money. So what we're trying to do is find that niche that's just outside the bank. So the quality assets that aren't getting financed with traditional money, but are too strong to stomach the hard money rates and leverage treatment on this side of the spectrum. We're trying to sort of fit in the middle. So we found a pretty good niche there. There's a lot of good assets that again are falling just outside the bank. So
good. Thank you. Thank you, Craig. Joseph.
Yes.
I'll turn to you next, please.
All right. Thanks, Alex. Good morning. Southcrest Bank is a community bank. We're headquarters in Peachtree City. We have a family of community banks in the middle Georgia, Upson, Polk County, Chickamauga, and then we have a couple of branches in Alabama. We're trying to deploy our deposits. We're a very heavy deposit base in those smaller markets. So we have 2 offices here in Atlanta, one in Tyrone and one in Johns Creek. My job is to build out a commercial team and help the bank deploy the deposits that we have. Our target market is we're going after, of course, C&I companies, and also we're doing commercial investment real estate. We do single-purpose properties, apartments, and we do new construction. We have partners with the SBA 504 program, and we're seeing a lot of activities in terms of just trying to get folks off the sideline to do some business. So real excited, and hopefully we have a good panel today.
Ken.
Okay.
Thank you, Joseph.
Yeah, good morning, everyone, and thank you all for coming out. Bank of America, as most of you probably know, is the second largest bank in the country in terms of assets. We are the 3rd largest bank in the metro Atlanta area in terms of total deposits. I am in the commercial lending group where the moderator mentioned we focus primarily on commercial and industrial companies up to about $50 million in revenue generally. Our mandate is really to provide a full range of banking services to those companies, obviously including credit. We provide loans for working capital, for acquisitions, for equipment finance, and we do primarily in my group owner-occupied real estate. And I'll talk a little bit more about that a little later in the panel discussion. But we're primarily interested in companies that are, from a real estate perspective, buying buildings that they plan to use in their operations in some form, where they're going to occupy at least 51% of the space long term. So we're very, very optimistic about the market. As you probably have read over the last few years, Bank of America has been in the news quite frequently in many cases for some not some very good reasons. But I'm here to say that the bank is certainly on the mend. We spent the last several years really restructuring the bank operations. We've invested in the bank in terms of business. We've sold off a lot of what we call non-core assets to build capital and liquidity. So Bank of America is here to stay. We've repositioned. We're on the mend, and we look forward to having a very good year throughout the country, and especially here in Atlanta.
Thank you, Ken. I want to ask each of you, is demand for the types of loans that you're making, is it, as the Fed survey suggests, is it rising or falling? And if so, what are you seeing as the main drivers of that demand? Is it refi, or is it new lending, other things that might be driving that demand? Joseph, if it's good, I'll start with you, and then we'll work our way around. Okay.
Oh, absolutely. I would say the demand is starting to pick up. The first quarter was a little slow because people are trying to get their tax returns and all that stuff. I think one thing that's driving demand that I'm seeing is kind of the refinancing. People are getting a little nervous with the rates being historically low for the last 3 or 4 years. Prime is at 3.25. So they're trying to lock in their fixed rate their assets to a fixed rate long-term maturity. So we're looking at a little variety of different properties year to date. We've closed in my shop a little bit over $4 million, and we had pretty much a different range of properties. We did an investment property with the office park. A little bit over $1 million, probably about 90% occupied, good cash flow. And we also done several medical dental offices in the Fayette area. So I would say, Alex, a lot of people I'm talking to, COIs, CPAs, customers are getting back in the game. Their fear of the prime rate going up. So they're trying to lock in fixed rates. We do offer both fixed and variable rates. Unfortunately, some of the refinancing on the larger buildings have swaps, and they're really not a good time to get out of a swap today with the prepaid penalties. So overall, I think the third quarter is going to be really robust in terms of refinancing. And I think people realize that these rates are not going to be low like this forever.
Well, thank you, Joseph. Ken, I'll turn to you next on this.
Yeah, I'd very much agree with Joe that we see demand coming back for loans in general. I think over the past 2 or 3 years, a lot of companies have pretty much been on the sidelines because of the economic environment. They've been deferring a lot of investment in machinery, equipment, buildings, computers because of the anxiety over the direction of the economy. So I think there's been a lot of pent-up demand out there, and over that 2 or 3 year time frame, a lot of companies have been investing in their businesses, becoming more efficient, finding ways to utilize technology better to improve their bottom line. So now they're ready to go to the next level, to expand, to grow, to make that acquisition, to buy that building, to invest in a new computer system. So we are seeing that driven primarily by, again, the pent-up demand that we've had, but also low interest rates. We're in an environment right now where rates are as low as we've seen in almost a generation, quite frankly. And obviously that market environment won't be sustained forever. So a lot of business owners are taking advantage of it and locking in fixed rates, as Joe mentioned, either for real estates or for other types of business ventures. I do see the lending environment continuing to improve. I mean, there are some restrictions on banks that have been imposed by the government due to the Dodd-Frank legislation a couple of years ago. But I think banks have begun to adjust to that, primarily the larger banks. And we pretty much know how to operate in this new environment now. So the thrust and the main focus for most institutions is going to be growing the top line. And frankly, the way that banks, traditional banks, make money is they have to make loans. I mean, there are other services that banks offer as well, but the most important product that banks offer or can offer is making loans and earning interest on those loans over time. So bottom line, I see the market for lending continuing to improve across the board for small loans, mid-sized loans, and large loans. But I think borrowers are being very sophisticated about approaching the market right now. They want to make sure that they get the best terms, the best structure in terms of how the loan is structured, and I think they'll be very interested in making sure that banks are going to continue to lend going forward. This is just not a temporary. This is not a temporary lending phenomenon for banks. So I think overall the lending environment is going to be strong going forward.
Craig, I'll turn to you. How do you see demand in the business you're in?
Sure, thank you. I'm going to focus my comments more on the CRE side. We do owner-occupied lending as well, but I'll let these two guys sort of speak to that and talk a little bit about the CRE side. I think for us, the demand, just by evidence that a group like ReadyCap was created, should tell you that the market is changing and coming back aggressively. Our focus is probably 100, well, let's say 500,000 to 7, 8, 9 million, and so kind of that small balance in the commercial real estate world, and what we're seeing is a bunch of refinance business where the banks have shed those assets, but they're still out there, and so we're seeing a lot of servicers that have taken properties back and have taken some discounts and are now trying to right-size these assets, and so I would say the majority of files on my desk right now are people that have good quality assets that went through financing problems because they were way over leveraged based on when they were built or bought. So a lot of what I'm seeing right now is just repositioning those assets, allowing folks through bridge financing, et cetera, to finish the stabilization, to finish the lease up, and then put good long-term permanent financing out there. So in that market space for good quality assets, it's very competitive. Rates are really good. We're again seeing a ton of activity there. So for us, demand is definitely increasing, and again, by evidence that a private institution was created to service that, should tell you that that there's a lot of demand out there.
Great, thank you very much. Ken, I'll turn to you. Craig's kind of addressed the question I had around new competitors, obviously being one himself. Ken, do you see any new competitors in the space you're operating in?
Not really. I mean, most of our competitors are banks our size, for the most part, Wells Fargo, SunTrust, that are out there, BB&T, but we're also seeing some of the smaller banks, like Joe's Bank, starting to emerge as being more aggressive, being more competitive. And as I said, banks are emerging from a period of retrenchment where we really cut back on lending because of issues with the economy. And banks are very, very anxious to make loans right now. The capital is there, the liquidity is there. So a lot of smaller banks are now venturing into to markets that they would not venture into 3 or 4 years ago, even when the economy was doing very well. Again, because of the pressure to put assets on the books. So I don't think the competitive landscape has changed as much as the competitive desires of the existing players has changed. I mean, I think you will probably see some more consolidation in the market going forward, and that has to happen. I mean, frankly, the U.S. economy really still has too many banks. And that's bad for the economy overall because it's an inefficient way for our capital markets to operate. When you will see that consolidation, I think that will be driven by the stock market because most bank deals are typically done through exchange of shares. So, but I think when you see it, you will see a even more competitive banking market, banks that are going to be more aggressive and will be more willing to lend.
Great, thank you. Joseph, I'll turn to you on that question then. Non-traditional competitors in your business. Or are you one?
I think a little bit of both. I believe, in our market, especially on the south side, Fayette, Coweta counties, we're seeing the competition for credit unions is coming up, where they're getting in the sandbox of trying to lend. And, the community banks, some of the bigger ones like the Synovus and United Community Bank, they're going more over of a regional model in terms of really kind of centralizing their underwriting. And I think the advantage for us as a community bank, especially my experience at some of the larger banks around here, we're very nimble in terms of flexibility. We're underwriting everything in-house. I have a pen, see, right here. Very fortunate to have my CFO, Chief Credit Officer, and CEO right in my office. So we can really get creative and kind of think outside the box. And again, I think it's still a space for community banks with a good reputation, a good foundation, and doing smart loans. A lot of the community banks used to be asset-based only. You're seeing a change since the downturn, being more cash flow driven. Unlike our competitors with the regional and larger banks, they want to see 10 years of cash flow or 12 years. And we're more of a 1 or 2 year cash flow where we can actually, again, think outside the box and get some deals done. So the biggest threat for us, I believe, is the credit unions. We're seeing Delta community credit unions popping up everywhere, but they're still trying to get their feet wet in terms of lending to businesses.
Great, thank you very much. With all that said about the competitive nature of the business today, leads to the next question, I think, especially in the minds of people that own real estate. Well, how about bringing those spreads in a little bit? How about getting a little more aggressive, more creative on that underwriting? Craig, I'll start with you. Are you seeing compression of spreads, underwriting standards falling, any of those things?
I guess that's a relative question. Certainly the spreads are tightening just because of competition on the good deals where lenders are really fighting for the good credits. Fundamentally, the difference between a bank and a finance company, and I've talked to some folks about this already. So, a bank looks at a scenario and tries to manage risk, right, when they're making a loan decision, and we all do. A finance company, though, kind of approaches it where we're trying to maximize yield. So there's a different approach to the same end, and so. I don't necessarily think that underwriting is loosening. Mm-hmm. Relative to where we were 2 or 3 years ago, absolutely. But the fundamentals are all still there. The project has to work, and the folks behind it have to be qualified. So we are by far not in a scenario where we were, 4 or 5 years ago, or I guess it's even longer than that now, where lenders were filling up buckets for securitization and then dumping that risk onto somebody else and not necessarily focusing on, on core underwriting. So, yes, it's getting more aggressive, but relative to where we've been, but it's still, I think the fundamentals are still there. From a pricing perspective, again, the quality assets, the strong business owners that are out trying to buy real estate are now beginning to have some leverage in the sense that lots of lenders want their business, and so I think for those types of deals, it's definitely the kind of the borrower's market, which has been different than it has been in the last few years.
Mm-hmm. Joseph, what are you seeing from your perspective? You mentioned credit unions.
Yes, I would agree with Greg. It's a lot of, I think the underwriting has not been loosey-goosey, but I believe that it's been more flexible. And also, I think for the community banks, they're looking at more skin in the game for the borrowers. Some of the problems that the community banks faced was that they were doing real aggressive loan-to-values and really taking all the risk in projects. And we're seeing a little bit more of a scale back in terms of making sure that the borrowers have some skin in the game. But our LTVs are still a little bit more flexible than some of the regional banks. I'll give you an example. Typically for owner-occupied, real estate, most banks would do 80%. We would do 85%. And of course, with SBA, you could do up to 90%. And for your investment properties, a lot of our competitors are doing only 70% loan-to-value, and we can do up to 80%. So again, the community bank is a little bit more flexible in terms of loan-to-value, but we're still looking at the cash flow and looking for the occupancy to be at a certain point, 85% range, and really good ownership is very key to us when we're looking at deals. So and again, I mentioned the credit unions. They're still not really that experienced in really doing a lot of commercial deals, and their structure is a little weak in some cases. So I still think we have a competitive edge in terms of really getting creative and getting the job done.
Okay, thank you. Ken, I'll turn to you on the same question. Compression in credit spreads?
Yeah, I really don't think our credit standards have been lowered over the last few years. I think we've gotten a lot more creative and flexible in how we structure deals. I mean, I'll echo what Greg and Joe said. I mean, when it comes down to it, fundamentally, we're interested in well-run companies. We're interested in companies that can have the capacity to generate cash flow on an ongoing basis, who have the ability to manage their balance sheet. I mean, obviously, too much leverage is a bad thing for everybody, for a lender, for a company. But I think when we look beyond the numbers on the paper, the balance sheet, the income statement, if we can see a solid business plan, if we can see a management team that has made some good decisions, even during the downturn, we are likely to be a little bit more aggressive in how we will structure a deal. I mean, we're still going to look at the underlying numbers, but again, we're in a competitive environment, so if we identify a company that we want to form a long-term relationship with, we're going to do everything we can to get that business without being irrational. I mean, there are a lot of banks in the market, not just in Metro Atlanta, but frankly throughout the country. One of the reasons that they had problems during the downturn is because they got very, very reckless. In their credit policy and their loan policy, they basically forgot the credit fundamentals. Does this borrower have the capacity to repay, even in a downside scenario? Do we have enough cushion from a collateral standpoint? As Joe said, I mean, typically in terms of commercial real estate, 80% is the loan-to-value that we're really looking for. We will go between 80 and 85%. But fundamentally, we're looking to that business to repay us. We're looking to the integrity of the individuals that are behind that business to repay us as well.
Great. Thank you, Ken. Joseph, I'm going to turn to you and ask you now to put on your economist hat And yeah, I know. I wish I was wearing mine at the time. Anyway, but where do you see interest rates, bless you, in the next 12 months and beyond? Your views.
Sure. You know, if I had that crystal ball, I probably wouldn't be sitting in front of you all this morning. I'd probably be on the beach somewhere. But I had this conversation with our director of finance, and we believe that you know, prime is at 3.25. Our cost of funds at Southcrest is 0.35 basis point. We feel like the bonds are ticking up a little bit. We feel pretty confident that the prime rate will not move this year. We think the next 18 months or so, we're targeting prime to be in the 4.5% to 5.5% range, which is still good. I remember when I started off in commercial lending, prime was at 10.5%, and we were doing high fives when it went to 9.75. So we're looking at a slow increase in prime. We believe that the feds are going to do it really slow, you know, maybe a quarter point here. But the economy is still kind of limping along, having a lot of problems in Washington. Can you imagine that? So we're really focusing on trying to deploy the deposits and taking advantage of our cost of funds to give some really good attractive rates. And we're doing terms up to 7 years, looking at, you know, the crystal ball of prime kind of creeping up after 18 months or so.
Thank you. Ken, I'm going to turn to you with the economist hat and ask you to give us your commentary.
Yeah, I would pretty much echo what Joe said. I mean, our forecast, as far as our forecast, meaning the bank economists, is that, you know, rates will eventually rise. I think in the foreseeable future, foreseeable meaning in the next 12 to 18 months, they'll be pretty much stable. I mean, I think the Fed has committed to keeping rates low at least until 2015. Now there's some question that they may revisit this bond buying program that's been keeping rates low, artificially low perhaps, in the market over the last year and a half. But again, because the economy has been growing so slowly over the last 18 months or so, unemployment has been stubbornly high. I mean, we're starting to see some improvement in the jobs numbers on a monthly basis, but until we see some more strengthening in the fundamentals, housing is growing, is a very strong. Has a very strong forecast going forward. Auto sales are very strong. And again, as job market picks up, the Fed might revisit, you know, its policy stance in terms of monetary policy and say, well, we think we may have to pare back this bond buying program and maybe give the message to the market that eventually, you know, rates may go up a little bit sooner than what we anticipated. But I think overall, until we start to see a real pickup in economic activity, and by that I mean GDP well above 2 to 2.5%, I think you're going to see rates pretty much stay pretty level.
Great, thank you. Craig, you're next.
You know, they sort of said it all. I've been wrong about interest rates for a long time. I've been telling every borrower that I've talked to for the last 5, 6, 7 years that rates are on the rise, and clearly they have not been. So, but I think these guys are right on. Everything that I'm reading and seeing is the same. That things are going to stay pretty flat for the kind of short to midterm. The economy just can't stomach anything that's you know, a radical increase. So if we see some changes, I think it'll be sort of the slow, steady growth. But again, until we get butts in seats with jobs, I don't think you're going to see a lot of changes in rates.
Thank you. I'm going to turn away from rates and turn back inward and talk a little bit about what we're facing as an industry with respect to regulation. And Ken, I'll turn to you first and ask, has regulation since the downturn with Dodd-Frank and the like had any impact on your business, and what do you see in the future?
Well, yes, the answer to that question is Dodd-Frank is probably the most, far-reaching piece of federal legislation that's affected the banking industry probably in the last 70 or 80 years, since Glass-Steagall perhaps during the Great Depression. So it's really forced banks to revisit how we look at credit, how we look at the different businesses that we are engaged in, and this might apply more to the larger banks than some of the community banks. One of the key elements of Dodd-Frank is changing the way, or more heavily regulating, I should say, the way banks participate in derivatives markets, swaps essentially. Many people argue that that was one of the factors that essentially brought down the economy. So banks are having to relook at that whole business and how we participate in it, how we approach customers with that particular product, how we structure our loans going forward as well in terms of what we can demand from borrowers in terms of collateral, in terms of how we structure interest rates in general. So I think you will continue to see more regulation on banks going forward throughout the industry, because I think Congress is determined not to have what happened in 2007 and 2008 happen again. Quite frankly, I mean, I think there's a lot of political pressure on a lot of people in Washington to make sure that happens. And regardless of what side of the political aisle you're on, I don't think anyone wants to see what we went through over the past 3 or 4 years. I mean, it was literally almost catastrophic. And I think maybe the average American, if you're not in the finance industry or in commercial real estate perhaps, don't really realize how close we came to a total meltdown in this country financially. So I think it's in the interest of regulators and also of banks to make sure that we're operating our businesses sensibly. We're making good decisions, not just for our individual institutions, our customers, our shareholders, but for the economy in general. Because as you saw, when you have a huge broad-based meltdown like we had, it affects everyone across the board.
Great. Yeah, great. I'll go to Craig first real quick, and then to Joseph, and we'll then get one more question and turn it to the floor. So just, Craig, I'll turn to you, please.
Sure. I think from our perspective, the regulations are affecting sort of what I'll call the velocity of money, right? So we talked a little bit before about how lenders were pooling assets and selling them, from the residential side, of course, and also into the commercial side. And that market, of course, went really quiet for a long time and is now beginning to come back. A lot of activity in the CMBS world. And so I think what the changes that I see or that would affect me is ReadyCap is going to be and is a securitized lender. So our business model is to pool these assets and to sell them on. The difference being that the rules around that securitization have tightened up. And so whereas before that originator would absolve themselves of the majority of the risk, I think the rules have tightened up considerably, and so that originator of that asset that's going to pass it down the line has got to retain some risk. And so I think that's going to slow down that velocity of sort of recycling the same dollar over and over again.
Thank you. Joseph, turn to you, please.
Yes, I would definitely agree with both of these guys. I think one thing, looking at from a community bank standpoint, is that we're required to have more liquidity on hand. That's a big key for the survival of community banks. And to give you an example, they want to see the Fed want to see at least over 6% of capital liquidity for a community bank. I would say under $2 billion. We're a little bit at 9%, so we have a lot of capacity in terms of liquidity. However, like I mentioned earlier, we have a lot of deposits in these small markets, but in order for us to make money, we have to lend money. So I think some things are really impacting, clients that you may be dealing with is the appraisals. A lot of the appraisers are kind of gun shy, very conservative, in terms of looking at deals. And again, like I mentioned earlier, we're looking at more skin in the game with the equity from the borrowers and with the properties not really being appraised like, let's say 4 or 5 years ago. Sometimes it get challenging with some of our deals. But I feel pretty confident that a couple of good things that came from some of these regulations is that it will allow banks to be a little bit more focused on doing the right thing. And I think we had the experience of that fake cash in terms of really going after derivatives and bonding things and selling off. So I think you're looking at more, the banks are kind of going back to the old bread and butter in terms of how they look to lend money.
Great, thank you. We'll conclude with this question, then I'll open the floor up for everyone. I wanted to ask each of our panelists, what are some of the opportunities that they have within their companies that they can take out to the marketplace, and some of the more attractive programs that are part of their offering. So I'll turn first to Craig and let you lead us.
Sure, and I'll make this quick because I know we're running a little short on time. But I think again back to sort of what I mentioned at the start of the panel is where we're trying to position ourselves is in between where the banks and life insurance companies and agency dollars just can't get there, whether it's leverage or stabilization or in some instances, a lot of instances, you've got developers or owners that have, they went through a credit problem, right? So they had to give a building back. They had to do something that's negatively affected their credit during the downside, and we see that often. So I think the opportunity that we create is an option in the middle. Where if that deal just can't fit into the bank because it doesn't have the stabilization or the leverage isn't quite right, we've got some creative folks that can come up with solutions to solve that problem.
Joseph.
Okay, thanks, Alex. I would say the same thing, except for we're in a position as a community bank to help your clients obtain financing. We can go up to 25 years for amortization. We can do 3, 5, 7-year maturities for your CRE customers. And we can be very flexible in terms of variable rates and fixed rates. And we have a good opportunity, again, to deploy these deposits that we have in our smaller markets to really take advantage of lending out some money in Metro Atlanta. So, I believe with the 2 offices that we invest in Atlanta, in Tyrone, Georgia, and Johns Creek, that we're positioning ourselves extremely well in terms of really being competitive and have an opportunity to do some business. And that's what our focus is going to be for the rest of the year, is getting some deals done. And we have the flexibility to be real nimble and quick in terms of making the process as easy as possible for your client and for the bank.
And Ken.
Well, real quickly, the bank in the last maybe 6 to 9 months has decided to focus very aggressively on financing for owner-occupied commercial real estate. Late last year, we rolled out a program where we are offering in the very first year a rate of 1.99%. That would be fixed. This would be for a loan, a minimum amount of $500,000. In the subsequent years 2 through 7, 2 through 10, we can also offer a fixed competitive rate that will be known to the borrower at closing. So that means you don't go through the first year without knowing what your rate will be in the years after the first year. That program has gone over very well. It's been obviously very competitive for borrowers that qualify. We can also use the SBA program with that program where we're offering 1.99% in the first year. We can also do a refinance of existing commercial real estate using this program as well. There are some flyers out on the front desk, so as you go out, if you'd like to take one, you can do that. My card is out there as well. Technically, this program expires at the end of June, so that means the application has to be in by that time, but there's a possibility that the bank may extend it for another few months.
Great, thank you all very much. Now I'll open the floor up if there are any questions. Happy to take them at this point. Yes, sir.
How do you guys do a non-recourse loan? Unfortunately, at this time, unless they're a client of the bank, we would have to have a PG.
Very rarely. I mean, there are some cases, depending on the strength of the company, that we'll go non-recourse, but typically our borrowers are S corporations, LLCs, privately held firms, so we typically will want to have the borrower in bed with the bank whenever we can. Anyone that holds more than a 20% equity interest in the company, we typically want to have a personal guarantee from.
I think the difference there is that, particularly as you're looking at owner-occupied, you know, that individual that's operating the business that they're underwriting to is sort of the linchpin in that situation. So I think for owner-occupied stuff, you're going to see personal guarantees more often than not.
Regions does offer non-recourse lending on commercial real estate assets, investor real estate. Typically, you know, it's all floating rate stuff, but they'll want to see a swap executed on the deal. If it's more than 3 years, we'll go out as far as 7, and we are typically lending on a lower leverage basis. It's sort of positioned in a place where it's going to be more competitive with life companies from that perspective around the leverage, and then you know, non-recourse without the structure of CMBS. So there's a limited amount of reserves, if any, with that. Yes, sir.
You're seeing a lot of refinance, you said. I think it was Joseph. Yeah. There's supposedly $50 million, $50 billion worth of commercial CMBS loans to be refinanced this year during the expirations. And they expect somewhere around 10 to 20% of them to default because of LTVs and et cetera. Are you seeing that, or is it still extended?
Well, again, we're seeing a lot of refinancing. Some of the problems that we're facing with the refinancing that you just mentioned is the LTV. However, as a community bank, we could be a little bit more flexible in terms of our LTV. I mentioned earlier that most of our competition for CRE deals are doing 70%. We can actually do up to 80% on commercial investment. So I still see that trend going up, and I feel like that we're going to be in a good position to help refinance some of those properties.
I think you're going to see there a continuation of what's been happening is a chicken contest between the sponsor and the lender on who's going to give, and you know, I've seen a little bit of everything. So I think on those types of situations, those properties are going to the pretending, I think, is going to slow down, and I think you're going to see. I know we're seeing a lot of repositioning of those assets where the lender's taking a bit of a hit, or they're selling that note to, you know, to a private equity company that's buying at a discount and then selling at a premium for them. A lot of lenders, at least over the last few years, have gotten rid of a lot of their assets, and so I'm not seeing as much legacy stuff anymore. It's all sort of second generation. What I mean by that is, again, that note was purchased by somebody else at a deep discount, let's say 50 cents on the dollar, and then they're offering that sponsor an 80 cents on the dollar. So so the borrower's taking advantage of that. So again, I think it's going to be a situation where the borrowers are going to have to put some equity in. If they haven't, I think that each situation is going to be a little bit different there. But lenders are still having to make tough decisions there.
Yes, sir.
Yeah, any development deals? Still looking to do development deals? You'll talk about cash flow deals and assets that are good quality cash flowing deals, but what about development deals?
For us, no. Seeing some of it in the market, particularly for multifamily. But for us right now, no new development.
That's not an area that I work in. There's a separate area of the bank that covers that, a commercial real estate bank, essentially. For what I've been hearing from them is that, yes, they are looking at development deals. They are being very, very selective, though, in terms of the project, the sponsor, the potential tenants. The underwriting is very, very, very closely monitored. It's very, very tight right now. So, but I mean, there are some development deals being done at Bank of America. I think typically they like to look at transactions above $10 million at this point. But again, they have to have a lot of confidence in the project and the sponsor.
Yeah, I would agree with Ken, except for we're going to look at the smaller projects. So I would say under $6 million, and for the right developer with the experience and the location, the whole 9 yards, we will take a look at that in our shop.
One more bank to say, yeah, we're doing them. We've primarily done multifamily over the last couple of years, but looking at other property types as well. It just depends, as they said, sponsor, project, market, all those things. Any other questions? Any other questions? We are very grateful to have such a good audience. Thank you all very much, and thank you for